Welcome to Early Age Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So today we are going to take a deep dive into United Vendor Horst Limited. United manufactures and reconditions hydraulic and pneumatic components, including specialized cylinders and seals. It offers on-site machining and marine services, combining advanced workshop precision with field flexibility. With advanced machinery and patented chrome plating technology, it serves marine, oilfield, and heavy industries. The revenue breakup of the company is as follows. From sales of products, the company generates 43% of the revenue. From sales of services, they generate around 56% of their revenue. And from others, they generate 1% of their revenue. So these are the industry which the company is serving. So it is basically, in simple terms, heavy machinery capital goods company which manufactures them as well as provides servicing services, repair and maintenance services for these machines to various industries. So we can see that it serves steel industries, oil and gas industries, and various other industrial components manufacturing or related industries. The management overview, the chairman and MD is Mr. Jagmeet Subberwal. So Mr. Jagmeet is very popular among the community, and he has been quoted as a transformational leader who has a history of acquiring companies in distress and then turning them around to profitability. This CFO is Mr. Kalpesh Shah, who has good technical background. And the board composition composes of 5 directors with 3 independent directors and no family members. So it's a business with independent governance oversight. Now the industry analysis is as follows. The precision and hydraulics and pneumatic industry is witnessing growing demand across industrial automation, defense, oil and gas, and marine repair sectors. And increased capital investment in India's infrastructure and core industries are triggering high demand for specialized manufacturing and reconditioning services, which the company provides. Also, rising ESG pressures and precision demands are shifting preference towards custom engineered low footprint solutions. So United Vendor is focused on such solutions, especially considering the fact that it has a patented technology which is like providing a chromium plating on diesel engines and gas engines, which improves their durability as well as increases fuel efficiency. So that way the company is well positioned in the industry. Also, regarding competitive intensity, it remains high due to fragmented market with low entry barrier and pricing pressures. So this is a complicated aspect of this industry. And also there can be supply chain disruptions, raw material inflation, and regulatory bottlenecks, which persist industry-wide risks. Now, the future look as guided by the management in their management discussion and analysis is as follows. Management anticipates that they are going to achieve prodigious growth driven by emerging sectoral tailwinds, robust expansion plans, and product innovation. And with increasing capacity installation and cost rationalization, the company targets low-cost production, higher margins, and enhanced stakeholder value. Also, the company's focus remains on global scalability, brand building, and delivering customized engineered solutions aligned with the market needs. So that way, the company is planning to deliver great returns in the upcoming few years. Also, the bull case scenario of the company is as follows. So the company has shown strong top line growth due to robust order inflow from marine, oilfield, and OEM industries. Also, margin expansion happened, which was driven by economies of scale from enhanced production capacity and optimized fixed cost allocation. Also, successful market penetration through value-added customer services and patented technologies added up given has given them an added advantage. On topping that, positive operating leverage from continuous modernization and investment in their core machinery is also very frugal for the company. And the strategic tie-ups and export opportunities are likely to unlock international growth in this domain. Coming to the bear case scenarios, rising competition and pricing wars can erode margins. Specifically, it's a highly competitive industry, and this can lead to lower capacity utilization. Also, supply chain disruptions can affect delivery timelines and client confidence, and failure to secure repeat orders due to lower brand visibility is can be a major challenge since the company is a very small company with a low market cap. Also, high capex without corresponding order book growth can lead to ROCE dilution, and equipment failure or environmental policy shocks can disrupt operations and hence their profitability. Now, coming to the 20 factor scorecard, the company came up with a preferential issue of 2.62 crores and a warrant issue of 2.54 crores in FY24. And the purpose was to purchase new machinery, enhance company's current equipment base, and also for working capital and general corporate purpose requirements. So I gave them a 5 years since the company is doing good capex. Also, regarding the director and promoter track record, we've already talked about how qualified their chairman and MD is. Also, they have got a good CFO, and their total promoter holding is 75% approx, out of which 69% is held by Jagmeet Subberwal alone. So I gave them a 5 year. Also, regarding related party transactions, they have got only 3.1 crores worth of purchase transactions with an enterprise in which the director is having interest, and this is also approved by board. Still, since it's a good percentage of the revenue, so them a 3 year. In board independence and composition, board is quite independent with a 60% independent director representation and 0% family on board. So I gave them a 5 year. Regarding CEO or KMP remuneration, so no remuneration is paid to any executive director. Basically, Jagmeet is the only executive director in the company, and he does not take any remuneration from the company. So that's a good sign. So I give them a 5 year. And regarding key person resignation, there has been only one resignation, which is the company secretary and compliance officer in 2024. So here also I give them a 5 since there are less resignations. Auditor has a tenure till 2027 and they are serving their second term. An auditor opinion has been unmodified over the past 3 years. The company does not avail any credit opinion, so that's not there. And I've given them a 5 because they have got unmodified opinions. Also, there is no regulatory or legal issue related to the company, and the company generally discloses generally does press releases and updates their quarter results quarterly. Also, the company very well described their business and their industry in their management discussion and analysis, but the company does not do con calls, so I gave them a 3 out of 5. Regarding business concentration risks, they serve companies like Tata, JSW, Reliance Industries, Mahindra, ONGC, SAIL, and SR. Also, there is not much information available on their client concentration, so I gave them a 3 pessimistically. Regarding CFO by EBITDA, so due to increase in working capital items and inventory, it has been low over the past few years. However, they have shown a significant increase and numbers are stable now. So I gave them a 5 years since CFO by EBITDA is 104% this year. Regarding revenue growth versus receivables, revenue has been growing at a very steady pace and receivables was also growing at a very high pace since last year. However, this year it has been showing a 3% decline. So that's a very good news. But revenue as a percentage of receivables is 38% still now. So on account of this, I gave them a 3 out of 5 here. Regarding inventory trends, inventory days are quite high. Also, inventory growth is also good and inventory is around 21% of the revenue. So I gave them a 3 year. Cash conversion cycle is quite bad. It's around 318 due to high DSO and inventory days, because of which I gave them a 0 here. Capex as a percentage of revenue is 11%, which is quite high. And fixed asset turnover is around 0 and asset turnover is 0.3. So I gave them a 3 year on account of this, and return on invested capital is around 8%. Debt and interest coverage is as follows. Debt to equity is 0.4, and they have reduced their debt quite significantly over the past few years, which is impressive. And interest coverage ratio is also good, so I get them a 5 year. Liquidity position is also, the company has been operating on a less than one quick ratio for a very long time now, and the company has been operating well. So I gave them a 5 year, and current ratio is also good. Also, regarding ROCE, ROE, and ROA, the numbers are quite stable and growing, but the numbers are also quite average. So I gave them a 3 year. ROE is just 9%, and ROCE is 11 12%, and ROE is 5%. So these are average numbers. So I gave them a 3 out of 5. Growth consistency is good. Revenue has been growing consistently over the years, and so has been the PAT. So the PAT showed a 137% growth since last year. So that's a good sign. So I gave them a 5 year. This sums up their total score in governance and promoter behavior to 46 out of 50, and in their financial health to 35 out of 50, giving them a total score of 81 out of 100. Now coming to the evaluation part.
Start analyzing currently the stock PE at 44. According to me, it's quite expensive for a company that is aligned to a lot of that has a lot of cyclicality elements. But over the last few years, they have grown impressively. The growth rate has been around 30-40%. So needs to see if that pattern that they have received is contributing to the growth, and they have been consistently growing. So that needs a bit more digging deeper into. But since the management is not providing much of con call, most of the information has to be taken from the annual report. But any which way, any which case, to be conservative, let's take the worst case scenario. The current stock is currently trading at 141. The margins as well have been improving, and over the last 5 years, except for 2022, which we need to dig deeper into to identify why there was a dip in margin. The margin has been in the range of 30%. So I would be conservative and upping my margin to 30%. And regarding price to earnings ratio, yeah, 38 looks still expensive. I would bring it down to 30 to be safer. The price target comes to 82. The stock is currently trading at 141. So that is a huge discount because I am being very conservative. Not we need to understand deeper into what has structurally changed in this business, and if the trend would continue, the growth of 30% plus. If that growth continues, and even if you give a PE, which is the current PE, the price comes to 198, then there's some upside potential, but then there is no margin of safety, is what I would say, because it looks like it is currently priced to perfection. Also, I'm very, though their cash from operating activity, it is positive, which is a good thing. They've also invested in capex the last 2 years. So let's see like how that plays out. The thing is, their working capital is something I'm not comfortable with. It is too stretched. This gives me a feeling that there's no moat in the business. So that is something I would urge all the investors to track. But just to quickly do a reverse DCF, the profit after tax is 4 crores. The cash from operating activity here is much higher at 11 crores. So I would take profit after tax of 4 crores, 4.36. So let's round it off to 4. The free cash flow is also at 9 crores. So let's be a bit conservative. And if a required rate of return is 25 and 3, and you have 5-year holding period, and I would give 15, but let's see like what it throws with 20. The trailing multiple of 20. The implied growth rate has to be 43%. But if you again take the 9 crores, which is a free cash flow, then it falls down to 25. The company has been growing at 30%. So if you have a longer period of 5 years, and if you know that what is driving this growth, then definitely the current price looks reasonable.
It is also reflected in the stock price chart. It has been stable around this 140 range. That is the final take on valuation. Do a deeper dive into understanding the factors that is driving this growth is what I would say, and whether the margin would sustain is the next question. So these two, if you know the answer to these two, then this looks attractive.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye-bye.